Hello everyone. Today we're gonna talk about the liquidity solutions in the private market. My team members are Jordan, Taha, Alpha, Grace, and me, Calvin. The first section is regarding the introduction to the private market. Let's start with some history. The concept of a secondary market, where the financial assets are traded after insurance, can be traced back to the Europe in the 17th century. In 1602, the Dutch East Indian Company became the first stock company, and the investors began trading ownership informally. This led to the creation of the Amsterdam Stock Exchange, which is considered the world's first secondary market. In the meanwhile, uh, a major fire in London happened in the 1600s, pushed the British government to issue bonds for the infrastructure. The demand for such instruments led to the formation of a bond trading platform. Since early development, stocks in the Amsterdam and the bond in the London laid the foundation for the modern secondary market, and they serve as the inspiration for building liquidity solutions in today's private market. Now, why does the liquidity matters? Liquidity allows the investors to meet cash flow needs and trade without affecting the asset price. It reduces to the transaction cost and contributes to the economic stability. In contrast, the private market tend to less liquid due to the limited transparency, smaller size, and a long lockup period. Because of this, the private markets investors expect a higher return in exchange for taking on a liquidity risk. These premiums can be attractive if investors have the ability and the time to hold the asset longer. Now let's welcome Taha to introduce the private market.
Thanks, Kevin. So I'll be moving to the next section, which is private markets and why they are growing. Just a few facts about the market. The current asset under management in private markets are around 15 trillion. This has grown from less than 4 trillion in 2010 to 15 trillion in 2023. And so very substantial increase in the last 14 years. And these private markets include private equity, venture capital, infrastructure, and private credit, among other, but these are the major markets. To give you an idea about the size of private markets compared to the global equity and fixed income market, it currently makes up around 6% of the total market. So this is a market that has been growing, is a substantial market, and investor interest is growing. At the same time, in contrast, in the last 30 years, the number of public companies in the US has gone down or almost halved from 8,000 to 4,000. So there is definitely a case to be made. So why are they growing? Uh, this is just the graphical representation of the numbers I mentioned, that the increase was from 4 trillion to now 15 trillion in 2023, and this number is further expected to increase at a fast rate. So the market size of private basically investments will be almost 20 trillion by 2028, and most of this will be due to, if we look at the general bifurcation of the markets within private markets, it will be from private equity, venture capital, and private debt, which make up most of the market. So why are they growing? The four key reasons we have identified are regulatory burdens on public companies, rising institutional allocation, the rise in complexity and size of deals in private markets, and generally higher fee revenue being charged by asset managers for investment in private markets. So, starting with the first one, the regulatory burden. So, after the scandal of Enron and its bankruptcy, the US government and some departments announced the Sarbanes-Oxley Act, which was basically made to help or improve transparency and objectivity of the representation of records in financial and business to the investors. But when you talk about, although this was obviously a positive point for the market in for the investors investing in public markets, but this has increased the regulatory cost of being a listed company or a public company. And in the current market, these costs represent 4% of the median firm's equity value, which is a very big number or a cost to bear for a business, when in actuality, this cost does not actually help the business operations or day to day function at all. At the same time, post the global financial crisis meltdown or the 2008 crisis, the Basel III regulations were introduced. These imposed stricter capital adequacy ratio and risk-weighted requirements for traditional banks. This has generally made lending more capital intensive and basically less profitable because more capital is locked up. So this is where private credit managers have been able to make a market for themselves. They basically operate outside of these both constraint, the regulatory cost and the Basel requirements or Tier 1 requirements. And they've been able to offer improved credit solutions of financing, which is why private credit has been increasing in market size. Moving to the second reason why the private markets are growing is the general increase of institutional allocation towards this market. I will basically show you a graph of the increase in basic allocation towards private markets briefly. But just to talk about those or summary of those points, previously private equity, private credit used to be very niche investment, usually made for either very high net worth individuals or specialized investors. But today they form a crucial part of institutional portfolios. So CPPIB, PSP, and different institutions hold now a large portion of the investments in private markets. And the reason for the rise in this allocation has been the portfolio diversification, higher risk adjusted returns, sometimes for endowments alignment with their long term liabilities due to the lockup periods in private markets, and the general overall lower correlation with public markets in terms of their returns. Additionally, these private investments provide access to a very high liquidity premium, which investors really like. At the same time, they sometimes offer an opportunity to invest in unique investment products, which are not usually not available in the public markets. So you look at these figures. We've compared the asset allocation of CPPIB in the last basically in a matter of 20 years. You can see that private equities went from less than 2% in 2004 to now almost 23%. And this does not even take into account that the overall asset under management for CPPIB have maybe quadrupled in the last 20 years. So although the allocation is much higher from 2 to 23%, the absolute size is maybe 10 times now investment in private equity. This is an example of state pension allocation. And so we look at the last 6 years for this basically asset administrator, and you can see that traditional assets made the 70% and alternatives made 30%. Basically moving up 6 years to 2023, and you can see that the 10% decline in traditionals went to alternatives. And we look at the specific numbers. You can see private equity went from 9.4 to now almost 15%. You can see private credit went from 2.1% to 3.7%. So both have almost increased 50%, whereas the decline you see is in non-US, US, and global equities, generally a decline of 10%. And so you get an idea of the bigger picture or the general view of institutional investors. Another reason for the size of the growing investment interest in private markets is the size and complexity of the deals. You also have a lot of so now private markets are becoming more accessible to individuals as well, not just high net worth individuals, but general individuals, and they make up almost 2.5% of the allocation of individuals versus 6% of the allocation of institutions when you look at their total investments and the allocation to alternatives. So how have general investors received access to these markets? So that it was through the introduction of flexible evergreen funds, which basically offer sort of like a continuous capital inflows and redemptions, and so this has improved the access. So how they do this is that they usually keep a substantial chunk of their asset under management in cash and liquid investment, so that the buying and selling of exit of these evergreen funds is possible for the average investor. And there is still a sort of redemption period. It's not basically traded daily, it's more of like a periodic period, so it can be quarterly or 6 months. At that point, you have the option to exit out of some of the investment that was made in these funds, not all of it. At the same times, uh, some articles are basically pointing towards the fact that there will be a generational transfer of wealth from boomers to millennials. This will be around 60 to 70 trillion in the next 10 years. And of this, 30 trillion US dollars expected to be heading towards investable assets. And we believe that uh, according to some surveys, younger individuals are more interested in alternate investments due to the higher returns offered compared to the public markets. So we think a substantial portion of these 30 trillion $30 trillion that will be investable will go towards private markets. And this is an example of the expectation of increase in basically alternatives AUM. And you can see that private wealth, which is basically individual, that increase is increasing almost three folds versus the institutional. Uh, share will or the size will only go up just 2x. And on the right, you see the increase in evergreen funds, which is a sort of ETF or mutual fund for investing in private markets, with usually higher lockup periods than obviously an exchange traded fund. But they are still a greater step towards general individuals being able to invest in the market. The last reason for the rise in private equity is the ability of managers being able to charge generally higher costs to operate these funds. So if you look at PE ratios, so basically we've compared three private asset managers with three traditional asset managers, and what we're able to sort of estimate is that the PE ratio required for the private managers was 30 times versus just 13 times for traditional investors. And so this gives you an idea of the investors' expectation of a higher return expectation, which is why they're willing to pay a higher PE ratio. At the same time, the effective fees charged by the managers, we've demonstrated that it's around 0.6% for alternative asset managers versus just 0.3% for the traditional managers. At the same time, the revenue per AUM is now, I think, almost 8 times for private managers. This is the sort of numbers that you can look at. So on the right side, so on the top, the three the companies or asset managers that we looked at in private alternate markets was Blackstone, Carlyle, and Ares Management Corporation. And you have the average profit margin, a fee rate, uh, price to earning ratio, and the price to AUM ratio. And on the bottom, we have traditional asset managers, so State Street Corporation, Franklin Resources, and T. Rowe Price Group. And you can just compare each sort of ratio. Profit margin, it's almost 30% versus 19% for traditional managers. The fee rate, as I mentioned above, was 0.6% versus 0.3% for traditional managers. The private equity ratio is 30 times versus 13 times. The price to AUM, asset under management ratio, is almost zero point 0.1 times by 0.01, so almost 10 times. And so the general idea is that the investor is willing to pay more for investing in private assets due to the expectation of much higher returns.
Amazing. Thank you very much, Taha. I will now be speaking about the inherent illiquid nature of private markets, the challenges that this poses, opportunity that can arise from it for institutional investors with a long-term investment horizon, and the potential solutions to this liquidity concern. Key reasons why private markets are illiquid are market structure, lack of standardization, governance constraints, valuation transparency, and regulatory barriers. Firstly, private market investments like private equity and private debt aren't traded openly on exchanges like the New York Stock Exchange or the Nasdaq. Instead, transactions occur privately through indirect negotiations involving intermediaries or over-the-counter methods. This decentralized approach creates higher costs, lower liquidity, and significantly slower transaction times. For example, private equity deals usually take 4 to 6 months approximately to finalize, compared to just a couple of days for public stocks or bonds to settle. For real estate deals, this is even longer, as they can take even 6 to 12 months to close because of the complexity from a legal standpoint and the extensive financial due diligence required. A major source of illiquidity is definitely the lack of standardized pricing and valuation methods. Private assets values are based on net asset values, which are updated quarterly or semi-annually, leading to valuation delays and uncertainty. Historically, this has caused private equity and debt assets to trade significantly below their reported net asset value in secondary markets, often at discount between 15% to 45% sometimes of NAV. This uncertainty makes it difficult for investors to accurately gauge the true value of their holdings. Moreover, private markets don't benefit from centralized clearinghouse like regular public exchanges, which means that transactions involve high counterparty risk, costly legal fees, compliance expenses, and advisory costs, which can even go to between 3 to 5% of the total deal value. That's a lot. These high transaction costs further discourage regular trading, worsening liquidity problems. Additionally, regulations like Europeans AIFMD and MIFID2 and Asia's foreign ownership prohibition rules complicate cross-border transactions and limit flexibility. Secondly, private markets also struggle with the lack of standardization. Each private deal itself tends to have custom governance structures, tailored exit provisions, and restrictive covenants, which makes transactions difficult to standardize and execute smoothly. In private debt specifically, customized loan agreements and variable interest terms lead to inconsistent pricing, limiting secondary trading activity. The absence of external credit rating also complicates accurate price discovery, leading to significant value gaps when investors try to exit these deals. Thirdly, the governance frameworks, plural, of private funds create additional liquidity challenges. Typically structured as closed-end funds, these vehicles require LPs to commit capital for 5, 15, 10 years, limiting their ability to redeem capital early into the investment. GPs control asset sales and often impose strict conditions on secondary market transactions, like requiring, for instance, GP approval or rights of first refusal, making it difficult for LPs to exit without significant discount. Capital call structures amplify liquidity pressures, as investors must maintain cash reserves for future calls without immediate returns. That's definitely an opportunity cost right there. As of 2023, approximately 3.9 trillion in committed and uncalled capital, referred to as dry powder, was locked in private markets. limiting investor flexibility. Fourth, and very important, private markets lack real-time mark-to-market pricing, which is common in public markets. This absence can create a misleading impression of stability, showing lower volatility on paper, but masking real risk. Investors might not see the true value of their investments until they actually sell their asset, potentially realizing significant losses at that point, or gains, maybe. However, this lack of immediate price visibility also leads to a unique advantage. Historically, private market assets have notably outperformed public markets during crises like the GFC and the COVID pandemic, delivering around up to 8% higher returns or lower losses in those cases because the market was down. And this occurs because the valuations appear less volatile in the short term, producing a smoothing effect that is very appealing to long-term investors like pension funds and sovereign wealth funds, as discussed earlier. Finally, several promising developments could significantly improve liquidity. That's the goal. Blockchain-based tokenization may simplify trading by enabling fractional ownership and faster settlements. AI-driven platforms are also emerging, automating due diligence and matching buyers and sellers more quickly, potentially reducing transaction times from months to days. Regulators in the US and Europe are also exploring standardized disclosure requirements and simplified rules to enhance transparency and market efficiency. These technological and regulatory innovations could greatly reduce transaction costs and unlock liquidity in private markets. In summary, while private markets face considerable liquidity challenges due to their structure, governance, valuation issues, and regulatory complexity, new solutions and regulatory reforms show potential to substantially enhance their efficiency and attractiveness going forward. I will now pass it on to Jordan.
Thank you, Alpha. That's a very nice segue into what we're going to be speaking about now, which is secondary markets and their role in liquidity for private markets. We're going to give a brief overview of the recent history in the secondary market. We're going to talk about different types of transactions in secondary markets, and then we're going to touch on what our growth outlook is and some of the more recent developments in secondary transactions. So just to give an overview of what this market actually is, the secondaries market is a place where people can effectively trade their underlying assets, whether those be LP positions in private equity funds or private credit funds or loans within private credit management vehicles. Also places where fund managers or GPs can actually transition their assets from one fund to a subsequent fund. So think about the secondary market just like how you think about the secondary market for public shares, in the sense that a company goes to the public market to raise shares, and then in those secondary markets, people like us can trade those shares. So in private capital, the figure that's been thrown around for churn rate is between 0.5% and 1% of private capital. Earlier in the slide deck, we showed you our approximate $14.9 trillion estimate for the size of AUM in private capital, and that churn rate of 0.5 to 1% on that 14.9 trillion gives us around $162 billion. That's what we're showing you here in the slides. And we think that there's a big possibility for that churn rate to increase to 1.5 or even to 2%. And at that $14.9 trillion in AUM at a 2% churn rate, that leads us to 298 billion. So a huge jump, I think, just from slight adjustments in churn rates. But so we're going to talk a bit more about that now. So what we're showing you here is a breakdown of equity issued versus equity traded. We tried to scale all the data as a percentage of GDP to make it more digestible. But 2023, that number for global GDP is around 100 trillion, 106 trillion. And in 2003, right here, that number is about 40 trillion. So just to put in perspective, but we're scaling everything as a percentage of global GDP. So this chart on the left, if you take a look at this yellow line, this is global equity issued as a percentage of GDP. As we talked about, it's been on the decline, and you can kind of see that downward trend here. But for the most part, it's been around 1% of global GDP. So if global GDP is around $100 trillion. 1% of that is being issued every year in new equity, so $1 trillion. Okay, so that's that yellow line on the left. This graph on the right is kind of what we consider to be a proxy for new equity being issued. It's not quite the same, but fundraising in private markets, that's kind of what we've used to proxy equity issuance in, or the equivalent of issuance in public markets. But that also is around 1% of global GDP. As you can see, it's been rising for the reasons that we spoke about. So on both fronts, we have issuance around 1% of global GDP. Great. Okay, so let's go back to this chart on the left here. This blue line, the scale is on the left-hand side, is giving us the volume of equity traded as a percentage of GDP. Volume of equity traded in the public markets as a percentage of GDP. This number is hovering more around 120% of global GDP. So just to reiterate, this yellow line, 1% of global GDP, around 1 trillion being issued, and then 120% of global GDP being traded of that same equity that's being issued. So 120 trillion in this case. So you can see that there's a huge, so much more trading is going on than issuance in the public markets, which makes sense. But I guess we propose to you, why can it not be the same case for private markets? Well, naturally, for the reasons that Alpha spoke about, we don't expect it to be 120%. It might not even be 50%. But if you take this, if we go back to this slide that where I was previously showing you, if you take that, if you just increase that churn rate from 1% to 2%, that almost doubles the size of the secondary market. So going from 162 billion to 298 billion dollars. And still, that percentage of GDP being traded in the secondary markets is only 0.28% of global GDP. So to double the size of this market, we don't even need to get it to a 10% of global GDP being traded, which would be great. But we only needed to take it to about 28 basis points to double. 28 basis points versus right now it's at 120% in the public equity markets. And here we're really trying to highlight the growth in the secondaries market. Over the past decade, we're showing you that this class has seen tremendous growth. As fund managers and investors alike are both beginning to understand and innovating in the space for the types of products and structures that allow these transactions to take place. Our paper discusses it in a lot more detail, but here you can see since 2016 really just the explosive growth in terms of transaction volume per year. And we're also showing you on the graph on the right, we're showing you the slight decline in the percentage of the LP-led share. We're going to get into the two main types of secondaries transactions and what this really means moving forward. So, and in this slide, this is a very important concept, and we're going to take a dive into some of the recent academia into this, but we're showing really the haircuts that investors take when they're selling out positions in the private secondaries markets. As you can see, for example, this blue line is showing you all of the or the average of all haircuts in the secondaries market. It's about 88% of NAV. So 12% haircut on average right now in 2024 right here. Um, when these people are selling these stakes in the secondary market. And it's important to understand exactly why haircuts are applied. And we're going to talk a lot more about that in a second. But I think it's interesting to look at how the different types of funds have different haircuts. For example, venture capital, you can expect a lot steeper um, discount for some things like uncalled capital, uncalled capital, um, illiquidity in the underlying investments and so forth, and then obviously for more liquid and fully drawn funds, you can expect a lot less discount. So we're gonna go into the works on some academics who who pretty much came up with a pricing model for how these um, interests are traded. And I think it's important to keep in mind that haircut, the haircut amount, you can kind of think of it like a bid-ask spread, but the average haircut is a good proxy for how efficiently secondaries markets are functioning. So by looking at this, I would probably say that the venture capital secondaries market is a lot less efficient, for example, than the buyout secondaries market. So we'll go into that now. So now we're going to talk a bit about that academic work. It's by Balin and Sensoi, and their whole study was about finding a way how to price these LP interests and figure out how much at a discount should they be sold from NAV, net asset value. And the premise was, these haircuts are can be looked at like a proxy for efficiency in secondaries market. So the math in it, to me, it looks like something out of a sci-fi film. So I'm not gonna even try to explain that, but more so we're gonna go into the intuition here. So the first thing that contributes to these discounts from NAV is Alpha covered this very thoroughly, is the inherent illiquidity in some of these assets. So the underlying projects, fund structures, etc. So we're not gonna double dip and talk about what he spoke about already. Another one is information asymmetry. So if there's a high perceived asymmetry in information, people or investors are they're gonna want a bigger haircut when they're buying it, and so that's gonna increase the haircut or the discount from NAV. Another one is anticipated liquidity needs. So if you're an investor that feels that you're gonna need to sell stuff in the shorter term, or maybe you don't have as high of a uh, starting point of wealth, you might be more inclined to demand bigger discounts when you're purchasing these assets. So that's how that plays into there. Um, Also, market conditions. This is one that I think is pretty intuitive. You can see it in the graph on the left here, showing you that, as you have lots of bad quarters in public equities, or, that's a kind of the market sentiments going on. If you have lots of consecutive bad quarters in public equity, you're going to have bigger haircuts when you're trading stuff in the secondaries market. And then, I mean, I think I saved the most interesting one for last, is this idea of uncalled capital commitments. So, these funds don't operate in the same, like, for example, if you buy a stock, as soon as you buy that stock, your capital is immediately deployed into that equity, and you start to receive the economic benefits of that stock once your money goes in there. This is a bit different. These funds operate off of capital commitments. If they're very sleazy, they might actually charge you a management fee on capital that you commit, which is not the same as capital that's actually invested. And so, let's say I want to invest in some private equity fund X. I'll go to fund X and I'll commit $10 million of capital. Over the investment period, which is usually about 3 years, they'll draw down on that capital commitment. So in the first year, they might say you've committed $10 million. We're gonna do our first draw on that capital commitment for $1 million, and then you still have to give us 9 million in the future. And if I don't meet those commitments, sometimes I can get fees, I can get kicked out of the fund, etc., etc. So over the investment period, they'll draw down, and my capital commitment will effectively be fully invested, and I'll therefore start to reap the full economic benefit of that $10 million being invested. So, long-winded way of saying that this actually behaves like a liability. when you're pricing these things, you can look at the uncalled capital commitments as a liability, and that intuitively decreases or increases the haircut from NAV that these things would be traded at or transacted at in the secondaries market. And it's also interesting to note that the actual volatility in terms of timing and size of capital of the capital draws do also have a pretty big role in terms of how much of an impact that liability of uncalled capital is assumed to have. So if you're in a fund that has very big or very sporadic capital calls, then that would in turn increase the haircut that's applied to that specific LP interest. So it's a very interesting study that gives us some insight into the mechanics as to why these things trade at a discount, and it's not just because the underlying is liquid, as we spoke about here. There's some other stuff that leads to that haircut as well. So I just want to remind everyone that our report is focused about liquidity solutions in private markets. You can look at this from two angles for the solutions available to investors and also the solutions available to fund managers. I'd put the LP secondaries that we just previously discussed. I would say that's more of a solution for investors, and this GP-led one is more of a solution to fund managers, but it has its benefits to investors as I'll explain shortly. So what is the GP-led secondary market? I know we kind of mentioned it a bit earlier, but what is it? Um, well, firstly, it's something that's grown 10 times in the past decade. So it's up 10x between 2013 and 2023. And this is largely driven by single asset continuation vehicles recently. And I just want to highlight that lots of the marginal growth in the secondary market for private assets is actually driven by GP-led secondary. So this is like a kind of a boom, like a boom within that boom of secondaries popularity. And I'd also like to point out that the single asset continuation structure is like a boom within the GP-led segment. So we'll get into that shortly. So what is it? GP-led secondaries is essentially a mechanism by where fund managers or GPs can roll their favorite assets or assets that they can't sell into subsequent funds. So just to give you an example, let's say you have a Brookfield Infrastructure Fund 4 and there's a highway in that fund and you like the highway, but your Fund 4 is coming to an end. Brookfield will then say, let's use a continuation vehicle, like a single asset continuation vehicle, to transfer that highway that we like from Fund 4 into Fund 5. So that's kind of the main idea. And one thing I'd like to touch on as well is the sponsor commitments in these SACVs are a lot larger than in their traditional LP pooled vehicles. So in the case of GP commitments, which we can look at as like a skin in the game for these fund managers, i.e., how much of their money from their balance sheet they're putting into these single asset continuation vehicles. It's about 5 to 15%, versus their skin in the game for your traditional LP pooled vehicles is lower, a lot lower at 1 to 3%. And I'm just gonna show you very quickly about the structure of these types of vehicles. I mean, our paper goes into more detail about the different builds and such that you can use, but largely the continuation vehicles will be used in like a SPV format. And so here we're showing you that you have your existing fund, your LPs or your investors in that fund. Let's say your fund term is coming to an end in your existing fund, and there's two companies in there that you really like, portfolio company 1 and portfolio company 2. Essentially, that GP can go ahead and create the SPV, the continuation vehicle, this guy right here. And that continuation vehicle will raise money from the GP. So it will take that sponsor commitment that we're talking about that ranges from 5 to 15%. It will take other investors who want to be rolled over into the new fund, or maybe outside investors. We'll talk a bit about that in a sec. And it will just buy out those assets, and it will essentially fund a capital return to those LPs in the existing funds. That provides an exit for existing LPs and also an opportunity for those LPs, if they really like those two, portfolio company 1 and portfolio company 2, gives them an opportunity to move into the continuation vehicle or into a subsequent fund, etc., etc. I know the title is single asset continuation vehicle structure, but this is like two assets in here. And single asset continuation vehicle obviously is just one asset. So I highlight that there. But that's generally how these things work. And it's important to think about the conflicts of interest that can happen when you have a GP that's essentially buying an asset from its investor base and rolling it into a new fund. They have huge committees that are responsible for making sure that all these conflicts are managed. So I just wanted to highlight that as well. And here we're showing you the growth in the GP led secondaries market. So again, I just wanted to highlight that a lot of the majority of the marginal growth in secondaries transaction volume is from GPs. It's from GP led deals. So I'm showing that to you right here from 2013 to 2023. It's gone up 10 times or as or over 10 times, and that's at a CAGR of about 26%. And then within that exponential growth, we can see that a lot of it is being funded by the growth in the single asset continuation vehicle. So when GPs want to roll over one asset into a subsequent fund. And as you can see a decade ago, in 2014, it wasn't even a thing. And now in the past 5 years, it's grown at a rate of 55%, which I think is incredible. Um, and so I'd also like to highlight to you, this is kind of what I was touching on a bit in the earlier slide, is the demand and supply imbalance of these stuff. So that's on the right side of this chart. Essentially, we're showing you that around $18 billion is or per year is going to be investor money going into this type of stuff. But at the GP level, there's about $83 billion of single asset continuations that GPs want to happen. And I think this just shows that this market still has a lot of growth left because it's so undercapitalized, about 5 to 1. So for every $5 of single asset deals that GPs want to do, there's only $1 of investor capital, and that really does tilt the favor into the hands of investors who are in these GPs are essentially going to try to compete for that investor capital. So it could offer very attractive returns. And one thing that I quickly want to touch on is the development of private credit secondaries. This market is not as large as the secondaries market for private equity shares, but I think it's worth mentioning. You know, we've learned a lot about the banking business as a moving business, i.e., they originate credit and then they try to offload it. They can do that via securitization or whatever, but that's the main reason why many people refer to the banking business as a moving model. And I think that private credit managers are slowly beginning to realize that because of the customized nature for some of these loans, like you might do asset-backed loans, etc., um, you can earn huge amounts of money on origination. And Apollo has on the record um, gone and said that there is more money in the origination than actually holding and servicing that private credit. So naturally, one would think that the inclination is to start originating more and then trying to get rid of that credit risk by offloading it. And that has led in the slide that we're in this yellow box, we're talking about the development or Apollo's development of a private credit trading desk, which is more so about trading investment grade debt that they've originated. And also, I think something worth mentioning is there's platforms out there like Percent that allow investors to participate in private credit loan origination, and then in many instances, depending on the actual structure of that loan, they could trade it with other investors on the platform. And this platform is catered towards giving retail investors an opportunity to be involved in the syndication part, but institutional investors can use it as well. And then Pantheon, the Pantheon is a like an asset management company that's mainly focused on um, structuring vehicles to enable the transfer of private credit assets. So think about it like kind of like a single asset continuation vehicle. or a multi-asset continuation vehicle, but specific to private credit. So they can come in and take loans off of a private credit fund manager's books and market that out as a secondaries fund. So yeah, like I said, private credit is in its earlier stages when it comes to secondaries, but it's something that is worth mentioning and something that we're going to touch on in a bit when it comes to CLOs. And then here we're pretty much showing you the size of the secondary volume versus exit value. And as you can see, we're seeing a secondary global secondary volume. It's taking up a larger and larger share of that exit value over time. So yeah, an important source of liquidity, very important source of liquidity in the secondaries market. So or the private asset markets when it comes to their exit value per year. So yeah.
Next, I'll be giving an overview of three important liquidity tools in private markets: NAV lending, subscription line financing, and collateralized loan obligations, or LCOs. As private equity and credit funds continue to grow, so do their liquidity challenges, especially during periods of market stress or tightening bank regulation. Traditional capital call process isn't always fast or flexible enough to meet the needs of GPs and LPs. That's where these tools come in. Each offers a unique way for funds to access capital, manage portfolio risks, or support investments without selling assets prematurely. Let's begin with NAV lending, which allows funds to borrow against the value of their current portfolio instead of relying on uncalled LP commitments like subscription line financing. NAV lending gained momentum after the 2008 crisis and during COVID-19, with the deal sizes now often exceeding 1 billion. And in the US, the NAV loan market reached around 150 billion by 2024, and is expected to double by 2027 as Basel III continues to squeeze bank-driven credit solutions. A 2024 survey has found that most NAV loans had loan-to-value ratios under 20%. 92% of proceeds were used to inject capital into portfolio companies, not to distribute to LPs. And spreads tightens from 685 to 592 basis points over SOFR in 1 year. NAV lending is especially popular in credit funds, where SPVs are used to isolate loan pools as collateral. In private equity and infrastructure, deals get more complex, requiring careful structuring to navigate leverage at the portfolio company level, regulatory approval risks, and co-investor agreements. Alternatives, like a preferred equity structure, are now more common in Europe to separate economic interests from control, reducing regulatory barriers. Recent large-scale transactions by Carlyle and Vista show how NAV lending can provide liquidity while preserving long-term value. Now, moving to subscription line financing, which has traditionally been used to bridge the gap between investments and capital calls. These are short-term revolving credit lines secured by LPs and called capital, and the benefits include smoother cash flows, improved IRRs, and faster deal execution. Lines can be as large as 30% of uncalled capital. But Basel III regulations have changed the game. Banks now face stricter requirements on leverage and liquidity. As a result, committed subscription lines have become more expensive and less available. To adapt, banks have shifted to uncalled credit lines, cheaper to maintain but riskier for funds, because the bank isn't obligated to fund every single request. Still, many funds are adjusting to this structure with success, especially if they maintain strong bank relationships. In short, subscription lines remain important but are evolving, pushed by regulation and pulled by the need for moving quickly. Finally, collateralized line obligations, or LCO, offer a securitization-based approach to enhancing liquidity. Historically used in syndicated loan markets, LCOs bundle pools of loans and issue bonds to investors. This model proved especially resilient during crises like 2008 and COVID-19, keeping liquidity flowing when other channels froze. Now, private credit LCOs are booming. In 2023 alone, they accounted for over 27 billion in insurance, about 20% of all new LCO deals. And these structures are tailored for middle market borrowers and often include rated feeder vehicles. For insurers, these feeder bonds offer lower capital requirements, just 2% for top-rated tranches compared to over 30% when holding private credit funds shares directly. Firms like Apollo have issued 30-year bonds to align with the issuer liabilities, offering strong yields and reducing liquidity pressure on the underlying credit funds. LCO often create a secondary market for private credit, encouraging wider investor participation and enhancing fund flexibility.
Now, let's move on to the section 6 on the future of liquidity in private market. The first is the tokenization of the private asset. It involves converting the private assets into digital tokens on a blockchain. These tokens represent a fractional ownership and can be traded much more efficiently than the traditional private market shares. Normally, the private market transactions are slow and manual, involves complex negotiations, legal structuring, and long due diligence cycles. But with tokenization, trades can be used smart contracts. It is automatic, secure, and often at a fraction of a cost. Also, the tokenized real estate projects are now allow the investors from the globe to own the fractional property shares. It increased the transaction volumes in the previous illiquid markets. However, the broader adoptions of tokenization will face challenges. Most regulatory uncertainty and a lack of standardized frameworks. Complex compliance rules for the tokenized assets differ across the jurisdictions, making cross-border transactions complex. However, the new regulatory proposals, especially from the SEC, could accelerate the adoption by providing much needed clarity. Next, let's move to the AI-driven secondary market platforms. The artificial intelligence is playing an important role in the price discovery, enhancing the valuation accuracy, also speeding up the deal executions. Historically, the private secondary transactions could take up to 4 to 6 months, but with AI, these timelines are shrinking into just a few weeks. Platforms like Forge Global and Nasdaq Private Markets are now reporting faster exits for private equity secondaries. The AI algos analyze the historical transactions, market trends, and the investor preference to match buyers and sellers more efficiently. These platforms provide dynamic, data-driven valuations, reducing price gaps and involving transparency. AI also helps the investors identify optimal exit timing by tracking market sentiment, fund inflows, and macroeconomic indicators. This allows the investors to better manage liquidity risks and plan rebalancing the strategies more proactively. Furthermore, the AI-driven risk assessment tools enable the uh, institutional investors to evaluate assets more accurately, forecast risk exposure, and adapt portfolios in real time. All of them contribute to stronger market confidence and lower liquidity risk premiums. Next is the future market evolutions. Although the AI has brought to the private markets, standardized remains a major barrier for AI models to deliver accurate insights. The private market transactions need to be recorded in a structured format. Regulatory agencies are now exploring mandatory digital reporting, which could enhance the effectiveness of AI tools. Looking forward, the technology advance and stronger industry collaborations are paving the way for the future growth. As the digital reporting standards become consistent and the data privacy concerns are addressed, investors' confidence in AI platforms will grow in the next future. Um, Finally, this progress will lead to greater transparency, faster transactions, and increased participation, driving a more liquid and efficient private market ecosystem.
So that brings us to our conclusion. We hope you guys enjoyed. Just to recap, we talked a bit about why private markets are growing, some of the key growth drivers into what's been pushing up the asset allocations towards these types of private assets. We talked a bit about what are some of the shortcomings or structural reasons as to why these markets are illiquid, whether those be regulations, the market infrastructure, etc. And then on from that, we talked a bit about some of the tools that investors and fund managers alike have at their disposal to help, deal with this problem of illiquidity, whether that be secondaries markets, NAV lending, subscription line financing, all these tools that investors and fund managers have to get more liquidity, or help solve for the liquidity issue that they may face in this type of business. And then beyond that, we talked a bit about what the future of this stuff could look like. We talked about AI stuff, the implementation of blockchain, and what we think these markets could look like in the coming years, as well as how existing solutions can expand as well and become better capitalized. So we hope you enjoyed the presentation. We hope you learned a lot. And yeah, until next time.